Welcome to Talk Tickers. Today, we're diving straight into the highlights of the Enbridge First Quarter 2025 earnings call.
Yeah, and what a quarter it seems to have been.
Absolutely. What's the headline? Well, it looks like record-breaking results across the board. We're talking record EBITDA, record DCF per share, and record earnings per share.
Exactly. Pretty impressive stuff. And these figures were primarily fueled by those recent U.S. utility acquisitions they made.
Right.
And also just strong volumes flowing through their big energy infrastructure network.
Okay.
And importantly for investors, I think management also reaffirmed their financial outlook for the rest of 2025.
So they're feeling confident.
Yeah, they're clearly projecting confidence in their model's resilience, even with all the uncertainties floating around in the global economy and commodity markets.
So it's a picture of strength in what could be a pretty volatile environment. Stability seems like a key message here.
That's right. Management really emphasized they're operating from a strong base amidst all this market volatility. Their strategy includes actively talking with policymakers, pushing for new infrastructure.
Why is that?
Well, they see it as crucial to meet growing energy demand, both here in North America and also for exports globally. Their core business model, which, they always describe as low risk, almost like a utility.
Yeah, they hammer that point home.
They do. And it's designed specifically to deliver predictable, consistent financial results over the long haul.
And it seems they're not just focused on growth, they're also keeping a close eye on the balance sheet, right?
Absolutely. Enbridge is committed to keeping their debt to EBITDA ratio in that target range, between 4.5 and 5.0 times.
Okay.
And they actually expect this ratio to improve as the year goes on, especially as those earnings from the new U.S. utilities really kick in.
Makes sense.
And interestingly, they also mentioned they don't see any big problems coming from current tariffs or, broader global trade stuff impacting their operations right now.
Okay, so stability, financial health. But they are still growing, aren't they?
Oh, definitely. Yes, they are. They're executing a disciplined growth strategy. They've already sanctioned around $3 billion in what they call accretive, low-risk projects just this year so far.
$3 billion already. Wow.
Yeah. And a big chunk of that, up to $2 billion, is planned for investment in their mainline pipeline system.
Okay, is that just for more capacity?
Well, it's not just about expansion. It's really focused on boosting operational efficiency, making it more reliable, and crucially, extending the life of that really vital asset.
Got it.
And they also gave the green light to the Birch Grove expansion on their T-North system. That's pretty strategic for supporting the growing LNG export capacity off the West Coast.
So with all these different parts, pipelines, utilities, renewables now, how do they, manage such a complex beast?
Well, that diversification is actually a major strength. Enbridge has built up this portfolio of, get this, over 200 distinct asset streams and business units.
Oh.
Yeah. And each one contributes to a steady, high-quality stream of cash flow. That stability is then sort of reinforced by their commercial structure. Over 98% of their EBITDA is backed by regulated frameworks or those take-or-pay agreements.
Which basically guarantee revenue.
Exactly, regardless of throughput. Plus, over 80% of their EBITDA has inflation protection built in, which is a huge advantage right now.
Definitely. Okay, let's maybe zoom in a bit. What were the key things from their liquids pipelines business?
Right, liquids. Well, that segment had a strong Q1. Their big one, the mainline system, hit a record throughput nearly 3.2 million barrels per day.
Wow.
And they're actively moving forward with those mainline optimization plans. The first phase should reach a final investment decision, or FID, later this year.
And what does that add?
That initial phase alone is expected to add about 150,000 barrels per day of extra capacity. They're also seeing strong interest from shippers in the Flanagan South open season, so demand looks solid.
Good sign.
And their Ingleside terminal, another record for quarterly volumes. They're planning to add another 2.5 million barrels of storage there, too.
Busy times in liquids. Now, natural gas seems like a really big focus area, lots of opportunity there. What did the call reveal?
Yeah, gas transmission is definitely positioned strategically. They're set to benefit from rising nat gas demand driven by, several things. LNG export growth, coal to gas switching for power, and
data centers.
Data centers, exactly. The huge energy needs there. They just announced a deal to buy a 10% stake in the Matterhorn Express pipeline. That's a big one. 2.5 BCF per day capacity.
Okay.
They also sanctioned the Traverse Pipeline project. That's going to offer bi-directional service on the U.S. Gulf Coast, ready in 2027.
And more to come.
Management hinted you expect more project announcements in 2025 and 2026, aimed at serving that growing gas demand. Their Permian franchise currently offers up to 5 BCF a day of egress, and they expect another 2.5 BCF a day online in 2026 with the Blackcomb pipeline.
So big bet on the Permian.
It's seen as a crucial opportunity, yeah. Capturing demand, embedded growth potential. Plus, they mentioned strong demand for their gas storage assets on the Gulf Coast, too.
Right. And Enbridge also has a much bigger footprint in the gas utility space now after those acquisitions. What's the latest on that front?
Yeah, this is the first full year they've owned those U.S. gas utilities. They've got rate cases happening right now in 4 major jurisdictions.
So waiting on regulators.
Pretty much. The outcomes there will be really key in shaping how they allocate capital in that segment. Up in Ontario, though, they got the go-ahead to start construction on the St. Laurent pipeline replacement program.
Okay.
And they expect decisions on the rate cases down south Ohio, North Carolina, Utah by the end of this year.
Got it. Switching gears slightly, what about renewable power? Making progress there, too.
Yep, steady progress. Their renewable power segment saw the Orange Grove solar facility that's 130 megawatts come online on time and on budget.
Always good to hear.
Definitely. They expect to bring over 500 megawatts of solar capacity into service this year, and it's all contracted with investment-grade customers, so stable revenue.
And looking ahead.
They anticipate more FIDs, final investment decisions, in renewables, largely driven again by data center electricity needs. And that European offshore wind project, Calvados Wind, is also moving along as planned.
Okay, quite a bit happening across all segments. Now, the CFO, Pat Murray, dove into the financials. What were the key takeaways from his commentary?
Right, Pat Murray. He really underscored the strong Q1 results compared to last year. Adjusted EBITDA up 18%.
18. Wow.
Yeah. DCF per share up 6%, and earnings per share up 12%. He pointed to higher mainline volumes and those toll escalators for the boost in liquid.
Makes sense.
Gas transmission grew 13%, even after some asset sales, mainly due to revised rates and the contribution from acquisitions.
Okay.
But the gas distribution segment showed the biggest jump year over year. That was mostly having a full quarter of contribution from those newly acquired U.S. gas utilities.
Right, the timing impact.
Exactly. The Ontario gas utility also did well. Customer growth, rate increases, and colder weather helped too.
Ah, the weather factor.
Always. Interestingly, he mentioned the stronger U.S. dollar. It meant bigger hedging losses, but overall it was actually a net positive for EBITDA and DCF.
Okay, so a net tailwind.
Yeah. And he reaffirmed the full year 2025 guidance, said they haven't seen any real tariff impacts. He highlighted that this strong Q1 puts them in a good spot to potentially meet or beat guidance for the 20th year in a row.
20 years, that's quite a streak. Any potential upside mentioned?
Yeah, potential upside for the Matterhorn pipeline deal closing and maybe favorable U.S. Canadian dollar exchange rates. They are watching U.S. interest rates, but don't expect a major impact right now.
Okay. And he talked about seasonality too, right? How the business ebbs and flows.
He did. He pointed out Q1 and Q4 are usually their strongest quarters, and that's even more pronounced now with the U.S. utilities added in.
Why is that?
Well, liquids can have heat restrictions in the summer, so lower volumes. Gas transmission sees more peak days in winter. Ontario Gas Utility makes more money in winter months. And even renewables, the wind resources, tend to be better in the winter, say October to March.
Got it. And capital allocation priorities? Still the same focus?
Pretty consistent. Priority 1, maintain the balance sheet, that 4.5 to 5.0 times debt to EBITDA. Priority 2, grow the dividend, but keep it within DCF per share growth. Priority 3, for growth spending, focus on low multiple brownfield projects and utility-like investments.
And funding it.
They expect to self-fund about $9 to $10 billion of organic growth annually. They'll deploy maybe $8 to $9 billion a year towards that big $28 billion secured backlog they have.
Leaving a bit left over.
Yeah, the remaining $1 to $2 billion is for opportunistic stuff, new projects, maybe M&A, or just paying down debt.
Okay, that covers the financials. The Q&A often throws up some interesting nuggets. What came out of that, particularly around regulation and maybe gas growth?
Yeah, the Q&A was insightful. There was definitely a sense of optimism, maybe cautious optimism, about a potential renewed focus on energy infrastructure and, crucially, permitting reform, both in Canada and the U.S.
Cautious optimism is probably the right word.
Exactly. They're watching to see if campaign talk translates into actual policy, but they expressed support for gas, liquids, LNG exports from the U.S., and said they're taking the Canadian PM at his word on commitment to energy infrastructure.
We'll see. What about their customers? Are they worried about price swings affecting projects like the mainline optimization?
Apparently not overly. They said their shippers, the customers, take a long-term view on demand. That underpins the confidence in the mainline work despite short-term price noise. Plus, those optimization projects are relatively permit-light, good multiples, and add capacity incrementally.
Okay. And the Permian outlook? Still bullish.
Still strong, yeah. Debottlenecking, smaller projects driving growth. They see building that gas egress capacity as basically insurance for existing production. Policy support for gas power is key, though, and faster approvals for electric transmission, too.
Right, it all connects. And those gas growth opportunities, especially data centers.
Huge potential highlighted there. Serving power demand data centers, coal to gas conversions. They said they've already secured deals to supply 5 gigawatts worth of gas to power plants in the last year alone.
5 gigawatts, that's significant.
It is. And they've identified over 35 potential opportunities, about 11 BCF per day of new electrical demand by 2032. That's like a $14 billion investment opportunity set for them.
Wow.
They think $1 to $2 billion of that could actually materialize in the next 6 to 18 months at attractive build multiples, like 6 to 8 times earnings. And that's just gas. They also have about 2 gigawatts of renewable projects serving data center clients.
So multiple angles on the data center boom. Anything else major from the Q&A? Guidance reaffirmation.
Yeah, reaffirmed annual guidance. Strong Q1 gives them a good start. But they did stress again how the U.S. utilities change the quarterly pattern stronger Q1 and Q4 now.
Right, the seasonality.
Exactly. Potential upside still there for Matterhorn and FX, still watching interest rates.
And Permian confidence holding despite some weaker nat gas prices commentary out there.
They remain bullish. Said they're aligned with their JV partners on capital deployment pace. The need for gas takeaway capacity is just, well, absolute, they believe. Sure. Gas pricing also provides a buffer if oil prices weaken. They monitor rig counts, but their contracted model makes them less sensitive to short-term price and volume swings.
Okay. What about M&A? Are they hunting for deals?
Their stance was basically they don't need to do M&A. Any deal has to compete really hard against their huge pipeline of organic growth opportunities like $50 billion worth.
High bar then.
Very high. They're always looking at tuck-ins maybe, but deals must be accretive to per-share metrics and neutral or better for the balance sheet. Haven't seen enough stress out there yet to create really attractive bargain opportunities, it seems.
Understood. Any specific pipeline mentions? Texas Eastern.
Yeah, Texas Eastern came up in relation to data centers. It's close to that Homer City project in Pennsylvania. They highlighted significant underutilized receipt capacity on Texas Eastern, like 60 GW worth of energy equivalent.
Really?
Yeah. So economical pipeline expansion options exist there. They're talking with developers, hyperscalers, hinted at potential announcements down the line.
Interesting. And just to clarify the seasonality point again.
Right. They wanted to be clear. Slide 13 wasn't formal quarterly guidance. It was just illustrative, showing the impact of U.S. utilities, the winter peaks for gas and wind, and maybe some summer dips for liquids. Just context.
Got it. Last couple of points from the Q&A. Ingleside Export Facility.
Still bullish on exporting everything, basically.
Mm-hmm.
Ingleside has advantages, cost benefits. They're expanding it, but also looking to maybe apply that model to other things. NGLs, LNG, low carbon fuels, building a longer value chain, even setting up a marketing affiliate. The contracted model gives resilience, especially if WTI prices soften and exports become even more important.
Makes sense. And finally, Ontario regulation. Any concerns there?
Not really. The ROE is set at 9.2% through 2029, so recent cost of capital talk doesn't hit them directly right now. They actually have an opportunity to over-earn a bit in Ontario before sharing kicks in. When allocating capital, they look at the whole picture. ROEs, equity thickness, capital recovery speed, regulatory certainty across all jurisdictions. Pleased with Ontario's commitment to gas.
Okay, comprehensive stuff. All right, let's pivot to our This Is Not Financial Advice segment. After absorbing all that, well, a slightly unconventional idea is bubbling up. The market often focuses on oil, right? But what if the real bottleneck, the real value driver in some places, is actually moving the natural gas?
That's an interesting angle, especially with all that associated gas coming out of places like the Permian and the pull from LNG and power gen, including those energy-hungry data centers we keep mentioning.
Exactly. So here's the thought. Maybe a bit wild, but potentially plausible. Consider going long Enbridge. Why? Well, they're pouring money into gas infrastructure right where it's needed, Permian, Gulf Coast. They're positioned to potentially capture a huge chunk of that gas transport demand.
Okay, long Enbridge makes sense based on their strategy. What's the twist?
The twist is pairing that long with a short position. Not an oil producer this time, but maybe. a major electric utility company that's still heavily reliant on coal-fired power, especially in regions where all this new gas pipeline capacity could make natural gas much more competitive.
Ah, I see the logic. If Enbridge's pipes help flood a region with cheaper gas, it could really squeeze the economics of an old coal plant, hitting that utility's bottom line.
Precisely. You're betting on that shift in the power stack driven by infrastructure. Enbridge facilitates the shift, potentially benefiting, while the coal-heavy utility maybe struggles with the new competitive landscape. It's a play on relative energy economics region by region.
It's definitely unconventional. Links infrastructure build-out directly to potential disruption in the power sector.
Yeah, reflects some of those underlying currents we talked about. But look, you know the drill. This is purely a thought experiment. Definitely not financial advice. Always do your own homework before making any investment moves.
Sound advice. Okay, that wraps up our deep dive into the Enbridge First Quarter 2025 earnings call. We've tried to pull out the most critical insights, give you a comprehensive look at their performance, and where they seem to be heading.
We hope this analysis has given you a valuable shortcut, helped you understand the key pieces of this pretty important earnings call. Now, what takeaway stood out most to you? We really encourage you to dig deeper, do your own research, and form your own conclusions.
And maybe a final thought to chew on. As this whole energy transition unfolds, it's complex, it's shifting. Companies that have that diversified infrastructure, assets across different energy types like Enbridge is building, well, they might just prove surprisingly resilient. Maybe even be the long-term winners. Something to consider from this call in that bigger picture.